Assalamu alaikum, my dear students. I hope you'll be fine. Um, this is Dr. Mahmoud Atifi. In this video, we are going to discuss the second part in IFM related to financial management in MNCs or multinational companies. We are going to cover such topics as cost of capital, multinational capital structure, multinational capital budgeting, and multinational short-term financing. We start with the introduction to multinational financial management, in which we seek to explain the common methods used to conduct international business and to identify management goals and organizational structure of the multinational corporation. Initially, companies are incorporated to produce certain products, and having a comparative advantage enable them to export their products to foreign markets. Thereby, they are engaging in some form of international business. Over time, many of these companies recognize additional foreign opportunities to expand more internationally. So, how can firms expand internationally? There are several methods the firm could use to conduct international business. The most common methods include international trade and licensing, franchising, joint ventures, acquisitions of existing operations, and establishing new subsidiaries. Let us discuss each method in more detail. The first method through which firms conduct international business is, of course, the international trade, which is considered a conservative approach used by firms to penetrate or enter foreign markets by exporting or to obtain supplies at a low cost by importing. This approach involves minimal or low risk. Why? Because the firm doesn't place any of its capital at risk. This implies that if the firm faces a decline in its exporting or importing, it can reduce or even discontinue that part of its business at low cost. Is Walt Disney produce a t-shirt? Is Walt Disney produces t-shirts? Of course not. But it simply give a clothing manufacturer permission to use its design of a popular character, Mickey Mouse, for example, on their products. Pepsi Cola give Heineken permission to make and sell Pepsi Cola in Netherlands. In a drug patent license, Pfizer gave patent license of producing and selling this medicine to Abico, which is Egyptian pharmaceutical company operating in Egypt. This type of international business called licensing. So licensing is an agreement whereby one firm in home country gives another firm in foreign country special permissions, of course in exchange for periodic fees. Special permissions such as technology, copyrights, patents, trademarks, or trade name. In this way, licensor or the company which give permission can generate revenue from foreign countries without establishing a production plants in foreign countries and can reach market without transportation costs resulting from exporting. But the major disadvantage of licensing is that it is difficult for the licensor to control the business operations conducted by the licensee So it is difficult to ensure quality control in the foreign production process. All of us know these brands that are widespread in each city of country. As you know, for example, McDonald's is international brand, but what you see in Egypt is a franchise of McDonald's because it is owned and operated by Egyptian residents. Of course, according to standards of McDonald's quality control. So, franchising is a business agreement by which the franchisor or the company which give the franchise provide a specialized sales or service strategy or support assistance to the franchisee, which is the local residents, to own and manage the operations. And the franchisor maybe contribute with initial investment in the franchise. But the franchisor gain the considerable degree of control over the operations. And this method of international business allow penetration into foreign markets without a major investment in foreign countries. The fourth method to conduct international business is to engage in a joint venture with a firm that operate in a foreign market so that the joint venture allows firms to apply their respective cooperative advantages in a given project. Typically, the joint ventures require some degree of direct investment. Let me show an example of joint ventures between General Mills and Nestle. General Mills joined in a venture with Nestle, thereby the products of General Mills could be sold through the overseas sales distribution network established by Nestle. Another example on joint venture was the partnership between Xerox company and Fuji company. Fuji is a Japanese company operating in Japan, entered in a joint venture with the Xerox company by which Xerox can penetrate the Japanese market and enable Fuji to enter the photocopying business. Third example on joint venture is a partnership between Wilmar and Kellogg company. Wilmar owned a subsidiary in China, joined in a joint venture with Kellogg to manufacture and distribute cereal and snacks products in China. The MNC can expand internationally by acquiring existing business firm operating in a foreign country, so the MNC will have full control over their foreign businesses and can quickly obtain a large portion of foreign market share. However, acquisitions entails or require large direct investment, large amount of funds to acquire existing operations or existing business, which involves risk of loss and also difficulty to discontinue if the subsidiary perform poorly. And to avoid these drawbacks, some firms engage in partial acquisitions, in which smaller investments are required than in full international acquisition, and this involve lower risk or less risk, and the firm will not have complete control over the foreign operations, and this represents a drawback of partial international acquisitions than the full international acquisition. In the last, the MNCs can expand by establishing new foreign subsidiaries. that will require large amount of funds and will not gain any revenue on investment until the subsidiaries is built and a customer base established. But in comparison with acquisition of existing operations, we find that establishing a new subsidiary may require smaller investment than buying existing business, and in addition, establishing a new subsidiaries allow operations to fit exactly the firm needs. We can compare the methods of increasing international business according to the amount of direct investment in foreign operations, which is foreign direct investment or FDI. In case of international trade and the licensing, there is no FDI because the MNC doesn't need to invest its own funds in licensing or international trade. In case of franchising and the joint ventures, they may require some investment in foreign operations, but only to a limited degree. But in case of foreign acquisitions and establishment of a new foreign subsidiaries, it involves the largest direct foreign investment. Actually, many MNCs use a combination of methods to increase international business. For example, GM or General Motors engages in substantial direct foreign investments and also derive some of their foreign revenues from various licensing agreements and franchising agreements that require less foreign direct investment to generate revenue. Between methods of increasing international business according to their effect on cash flow of MNCs. The first diagram illustrates the case of MNC that engages in international trade. Its international cash flow results either from paying for imported supplies or from receiving payment in exchange for products that it imports. The second diagram illustrates an MNC that engage in some international agreements which could include licensing, franchising, or joint ventures. Any arrangement may require cash outflow to cover expenses associated with transferring technology or funding partial investments. These arrangements generate cash flow for the MNC in the form of fees for services like support assistance that provided by the franchisor or licensor or the MNC. The third diagram illustrates the case of an MNC that engages in foreign direct investment. This type of MNC has one or more foreign subsidiaries. There can be cash outflow from the parent company to its foreign subsidiaries in the form of invested funds to finance the operations of foreign subsidiaries. And on the other side, the foreign subsidiaries remit earnings or fees for services to the parent. And it's worth to mention that our focus in this module will be on the MNC whose parents fully own the foreign subsidiaries. The second part in lecture 8, we want to discuss what is the role and objective of financial management in MNCs. Firstly, we want to recall the main decisions taken by the financial management as you studied in business finance module. Actually, financial managers take three main types of decisions. The first one is capital budgeting. Capital budgeting refers to corporate investment decisions. So, taking the long-term investment decisions. The second decision is capital structure. Capital structure refers to the suitable mix of debt and equity the company used to finance investments. The third decision is working capital management or short-term financial management, in which managers decide how to manage the daily financial operations of the business. All these decisions taken by financial management officers in the MNCs. In addition to the main decisions taken by the financial managers in domestic company, financial managers in multinational corporations can take decisions such as if to discontinue operations in particular country or to conduct a new business in a particular country, decisions about the expansion in a particular country, and how to finance expansion in particular country. All these decisions of each MNC are particularly affected by other business discipline functions. For example, the decisions to conduct a new business in a particular country is based on comparing the benefits and the costs of such expansion. Information about the potential benefits of a new business depend on the expected consumer interest in the products to be sold. This information will be provided by marketing department, while the potential or the expected costs of resources needed to conduct the new business is provided by the management department. Financial data will be provided by accounting and information systems department. All these decisions, either financing decisions or investing decisions, have main objective, that is maximizing company value represented in its stock value. In other words, the main objective of financial management is to maximize wealth of shareholders. Suppose that in choosing a location of a new subsidiary, the manager selected the location based on his appeal, for example, for entertainment, instead of its potential benefits to shareholders. Another example, suppose that managers is motivated to expand the existing subsidiary to receive more compensation rather than to enhance the value of a multinational corporation. In both cases, decisions are taken in the interest of managers, not in the interest of shareholders. So this situation indicates the conflict of interest between managers and shareholders. That is called the agency problem, which arises from separation of management from ownership. This means that if major shareholders are themselves the managers of the company, the agency problem will be minimal. So, from the stockholder's point of view, a good financial management decisions which result in higher stock value. So good decisions should increase the stock value, and poor decisions will decrease the stock value. If the managers fail to make the best investment decision, choose riskier investment, or choose investment will not achieve the investors' interest, or to maximize personal objectives. These decisions will decrease the share price, so shareholders experience loss in their wealth, and this is called agency cost. So the potential or the drop in share price will represent cost for the shareholders, and this is called agency cost or one form of agency cost. So the decision rule for managers only take the actions that are expected to increase the share price. So the financial managers facing alternatives or actions for each financial decisions, they will compare the risk and return of each alternative. The decision which result in higher stock price or will increase share price will be accepted from the investors or stockholders. So financial managers will choose this action or this alternative. Otherwise, the financial managers will avoid this action or these decisions because it will decrease the stock price and will not be acceptable for the investors or stockholders. But not all the time financial managers take decisions in the interest of stockholders. So agency costs are normally higher or lower for MNCs than for purely domestic firms. Sure, the agency costs are higher for MNCs because of three factors. The first one is distance. Because monitoring managers of distant subsidiaries in foreign countries is more difficult than monitoring managers in domestic company. Different cultures. Foreign subsidiary managers in different may have different cultures and consequently they don't have uniform goals. Share size. Actually, larger MNCs can create large agency problems because it complicates the monitoring of managers. Okay, how can agency problem be controlled in MNC or in multinational corporations? Actually, there are three methods or three ways the MNC can control the agency problem. The first one is parent control, second is corporate control, and the third is government control. In in the parent control, the main objective is to ensure that all subsidiary managers focus on maximizing the value of MNC and not of their respective subsidiaries. So the managers and the parent company will communicate the goals for each subsidiary and oversee subsidiary decisions to check if each subsidiary's managers are satisfying the MNC's goals or not, and implement compensation plans that reward those managers who satisfy the MNC's goals. Management compensation plans include incentive plans and performance plans. Incentive plans are providing stock options for the managers for which the managers are encouraged to take decisions that can increase share price and they will exercise the stock options. Performance plans connect the performance of management or performance of managers represented in earnings per share, for example, to cash bonus at the end of each financial period. So the corporate control refers to if managers are making poor decisions and institutional investors can claim for the board of directors to fire the top managers or even to fire board member. The second type of methods can be used to control the agency problem is the corporate control. The corporate control uh, refers to any misusing of firms' resources. It is a case of agency problem, of course. Will depress the share price, and this is the agency cost, making the firm an attractive takeover target by another firm. So the MNC or the subsidiary will be subject to hostile takeover, and under this case, the management will be restructured or fired by the new acquiring firm. Government control refers to provisions of civil or criminal prosecution of individuals who conduct unethical acts or illegal acts in the name of the firm. An example on the lack of monitoring, which can lead to substantial losses for MNCs, the large New York-based bank JP Morgan Chase and Company lost at least $6.2 billion and had to pay more than $1 billion in fines and penalties after a trader in its office in London made extremely risky trades. The subsequent investigations revealed that the bank has maintained poor internal control and failed to provide proper oversight of its employees. Now we want to discuss the management structure of MNC. We have two types of management styles in MNCs, centralized and decentralized. As shown in this exhibit, this is centralized management style in which the financial managers of the parent directly supervise each officer in the financial management department in each subsidiary. For example, the cash management officer in subsidiary A and subsidiary B directly report for the financial managers and directly supervised by financial managers in the parent company. And by the same way, inventory and account receivables officer, financing officers, and the capital expenditures officers in each subsidiary, their decisions are supervised by the financial managers and the parent company. In this exhibit, you will observe the decentralized management style in which the financial managers in each subsidiary supervise directly each officer in his subsidiary. So the cash management officer in subsidiary A will report to his manager in the subsidiary. And the same way for inventory and account receivables management officer, financing officer, and control capital expenditures officers will report to his manager in the subsidiary and will not report to the financial managers in the parent company. The most important questions is does the magnitude of agency costs vary with the MNC's management style? Actually, we will compare between the decentralized and decentralized management style. in centralized management style, managers of the parent can attain the control on the foreign subsidiaries managers, they can reduce the power of subsidiary managers and can minimize the agency cost. But the parent managers can make poor decisions for the subsidiary if they are less informed than the subsidiary's managers about its setting and financial characteristics. So, as there is potential to decrease agency cost, there is risk of taking poor decisions. And decentralized management style, the control of each subsidiary is attained by the managers in each subsidiary. So they are closer to the operations and the environment and make decisions that may fail to maximize the value of entire MNC. So the agency cost in the decentralized management style is expected to be higher. So in short, centralized management style can result in lower agency cost, while decentralized management style can result in higher agency cost. But the disadvantage of centralized management style is the possibility that parents managers may make poor decisions because they are less informed about the financial characteristics of each subsidiary. Decentralized management style enable subsidiary managers to take decisions independently from the parent, so they may take bad or poor decisions that don't maximize the value of the MNC, so the agency cost will be higher. Okay, given a trade-off between centralized and decentralized management style, some MNCs attempt to achieve the advantages of both. How? The subsidiary managers can make the key decisions about their respective operations because they are more informed about the financial characteristics of each subsidiary, but the parent's management can monitor those decisions to ensure they are in the MNC's best interest. We try to explore a decision to expand internationally using case study of a Blat incorporation. The first of all, we want to introduce the basic data about the company. Blat Incorporation is a US-based company, has been incorporated in the United States for 3 years. Blat is a small company with a total assets of only $200 million. The main product produced by the company is roller blades. So it is a single type product company. Due to the booming rollerblade market in the United States at the time of the company's establishment, Blatz has been quite successful. However, Blatz produces high-quality rollerblades and employs a unique production process, but the prices it charges are among the top 5% in the industry. Current status of the company, it reported a return on assets of only 7%. So the company's annual reports for its most recent year of operations results in fall in the stock price from $20 per year 3 years ago to $12 last year, and the Blat shareholders have been pursuing the companies to improve its performance. The company limitations or constraints. There are no other cost-cutting measures that Blat can implement in the United States without affecting the quality of its product. In addition to the production of alternative products would require major modifications to the existing plant setup or the business lines. Expansions within the United States at this time seems pointless. Company plans. The chief financial officer of Platts face three plans. The first one to import some parts from overseas at a lower cost and to expand the company's sales to foreign countries and establish a subsidiary in foreign country such as Thailand. We will analyze each plan. First one, import some parts from overseas. Actually, the CFO's initial focus is on Thailand. Thailand has recently experienced weak economic conditions, and Platts could purchase components there at a low cost. The CFO is aware that many of Platts' competitors have begun importing production components from Thailand. The second plan is to expand the company's sales to foreign countries. Similar strategies have proved successful for numerous companies that expanded into Asia in recent years to increase their profit margins. Although several of Blad's competitors import components from Thailand, few are exporting to the country. The third plan is long-term plan to establish a subsidiary in Thailand and gradually shift its focus away from the United States if its US sales don't rebound. And establishing a subsidiary in Thailand would also make sense for Blat due to its superior production process. CFO is sure that Thai firms couldn't duplicate the high quality production process employed by Blat. Furthermore, if the company's initial approach of exporting works well, establishing a subsidiary in Thailand would preserve Blat's sales before Thai competitors are able to penetrate the Thai market. The required in this case, as a financial analyst for Blat, you are assigned to analyze international opportunities and risk resulting from international business. Your initial assessment should focus on the barriers and the opportunities that international trade may offer, especially if the CFO of Blat has never been involved in international business in any form and is unfamiliar with any constraints that may inhibit his plans to export to foreign country and to import from foreign country. So the CFO has presented you with a list of initial questions you should answer. The first question is about what are the advantages Blat could gain from importing from and or exporting to a foreign country such as Thailand. The second question is about what are some of the disadvantages Blat could face as a result of a foreign trade in the short run and in the long run. The last one, what long-range plans other than establishment of a subsidiary in Thailand are an option for Blat and may be more suitable for the company? The first questions you as a financial analyst has to answer is about what are the advantages Blats could gain from importing from and or exporting to a foreign country such as Thailand. The advantages Blats could gain from importing from Thailand includes potentially lowering Blats' cost of goods sold. So if the inputs are cheaper when imported from Thailand, the net income of Blats will increase and its competitiveness in US will increase in comparison with its competitors in the United States. And since Platts is considering large range plans in Thailand, longer range plans in Thailand, importing from and exporting to Thailand may present it with an opportunity to establish initial relationship with some Thai suppliers. And as far as exporting is concerned, Blatz could be one of the first firms to sell roller blades in Thailand. The, the second question the financial analyst should answer is about what are some of the disadvantages blades could face as a result of foreign trade in the short run and also in the long run. The first disadvantage is currency fluctuations in the Thai currency. For example, the dollar cost of imported inputs may become more expensive over time if the Thai currency appreciates, even if the Thai suppliers don't adjust their prices. The second risk is economic conditions in Thailand. If there is a recession, a pledge company would suffer from decreased sales in Thailand. The third risk is any regulatory and environmental constraints. If the possibility that Thai government may impose on the pledge company any pollution controls. Geographical distance will make monitoring very difficult because Thai managers may conform to goals other than the maximization of shareholders' wealth. The third questions the financial analyst should answer is about what long-range plans other than establishment of a subsidiary in Thailand are an option for Blatz and may be more suitable for the company. Actually, the CFO of Blatz is very unfamiliar with international business, and in addition to the company has never operated outside the United States. Because of the two reasons, it is establishment of a subsidiary in Thailand is probably not the best way for Blats to gain a foothold in Thailand in the long run. So, as an alternative, Blats can initially consider a joint venture with Thai firms that manufacture roller blades to get access to Thai distribution channels and to be more familiar with the Thai firms with customs and ethics in Thailand.